In this video, I'm going to talk about why investors pass on businesses. To fully understand this, you need to understand how investors think, what they look for, what they prioritize, and effectively what their success criteria is. The key thing to understand is that bad investors see risk and then they just walk away. Good investors see risk, but price it at a way where they say, if we can get this price, this risk is worth taking. Now, to illustrate this, I'll give you an example. Let's say you have a street of terrace houses that's valued at £1 million each. They're all identical, same size garden, same layout, same everything. But one of them has a terribly leaky roof. Are you going to pay the £1 million for it? No, of course not. Nobody would. Because there's a risk there and you'll have to fix it and you have to pay money. However, if you were to buy that house for £300,000, as long as the cost of fixing the roof was somewhere in the gap of 700, you'd consider it. And your returns would be better than if you just bought the house. The most important part of this analogy is to note the risk hasn't changed. You know that you can fix the roof problem and there's no market risk because the houses stay the same. So it's just about the entry level pricing. That's the key distinction here. So in the first scenario, there's no return because you're buying at $1 million and you're going to sell for $1 million. So there's no return. But in the second scenario, where let's say you can buy for 300 grand plus a 50 grand roof fix means a 1.8 times multiple on your capital. Pretty compelling, right? And all you have to do as an investor is find that deal. Now, obviously those deals don't get found anymore. This type of deal, you could find this in the 70s and 80s in the UK, but it doesn't exist anymore because there's so much capital going into residential real estate, particularly value-add real estate. So those deals get priced out. If you want further reading on this, look up perfect competition in economics, and it will explain basically about barriers to entry to certain markets and how that impacts an ability to get profit in that market. But I use that example because it is, and I know of deals that are similar to that have happened in logistics, in offices, in retail, all over real estate, and certainly within companies. You hear about companies that get bought for some crazy number because they have an email list, and that email list in their hands is worth X, but it's worth 100X in the hands of somebody else because it might impact their customer acquisition costs or their LTV or whatever it might be. So this is the important thing, is to think about how you value things in terms of risk. And it's about finding risk that is mispriced. I'm going to bring up a slide here. This is a risk return matrix that's typically taught in investing, where, along the x-axis, you'll have the amount of risk that you take, and along the y-axis, you'll have the return. And what you'll see is like a flattening upwards curve. I don't agree with this. I think this type of graph is frankly rubbish. And my job is to find the ones that are the lowest risk and the highest return. And those exist. You just have to understand the market intimately well to be able to find them, and you have to be good at your job and diligent. And it was this mispriced risk phenomena that basically caused me to leave my private equity job in the city to join a startup who I believed, and was then proven correct, in that they had mispriced, that the market had mispriced the risk of a certain product in the UK. And we managed to convince some of the UK's best investors to invest millions and millions of pounds into that business. It's gone on to do extremely well. And because there was conviction on this misprice point. And that was my job as part of that team growing that business, was to establish this frame to the investors, communicate that idea, and show even if X, Y, Z were to happen, this business would still do well. All that context, now we're going to get into the fun stuff. What I'm going to do is I've got Claude to build me DD documents, right? I've not looked at these. I've obviously given a bit of context in the prompts, but I've not really dug into them in any great detail. So what I'm going to show you is I'm going to pull up my laptop. I'm going to show you how I think about investing when I look at key DD documents. And then that way, I'll be able to give you tactical advice on how an investor seeing certain weaknesses in your documents, because you will have them, how they would either want pricing to come down, or how they would want further parameters or constraints put in place on either the operator or the team, or even how the business is allowed to operate with the investment in order to satisfy their criteria as an investor. Right, so what I've done is I've got Claude to create some mock DD documents. So this is one called Howgrove Technologies. So this is a financial model and a summary P&L. They're doing a Series A process. and it's a hardware subscription business. Okay, everything's in the thousands, right? So Claude's done okay here. But effectively, the first thing I'm looking at here is I'm looking at the growth, because everything should be top line down and through with each line item. Now, nothing here, the worst sin you can commit as an investor, particularly like a PE investor, somebody who looks at businesses from a finance perspective, is spreadsheet maths and living in the spreadsheets. I'm trying to not do that by looking at how these things intermingle with each other. Now, if I pull this down a bit, you'll see that everything's hard-coded. Oh no, it's not hard-coded. But there's no growth calculations here. So typically the first thing I do is look into the growth calculations of whatever driving these numbers here, right, for the devices shipped. Because really this should be connected to marketing. Right, so in this business, they are going from 8,000 units to 12,000 units. So it's an increase of 50% by basically increasing their sales and marketing by 50% in the first year. But then by 2027 to 28, they're basically doubling and also only increasing their sales and marketing. So what that is telling me is that these guys are betting big on branding being a huge thing. And what I want to do is I want to dig further into how their marketing has been done historically. Because for this model, they're already doing 12,000 units as an actual. And really that's the thing that I want to dig into. So I want to understand who in the team is responsible for this, why they're so confident they can get to 200,000 by only spending 1.4 million on marketing, and where the brand component is going to come in there. So that's the first thing. Yeah, so this is the other thing, that when you scale up revenue, obviously you're scaling all the other parts of the business. Now, it seems to me here that you're basically shipping, what's that, like 15, 17 times the volume by, 25 times the volume, but with how many more people? Here we go, head count. So you've got a total head count of 7 more people, but you've got 25 times more volume shipped. That is pretty mental. This hiring plan is going to have some serious analysis, understood why that's going on. This is the type of thing where if they can have a good answer for this is a cracking business, right? But it's about me interrogating that answer, because it's huge operating leverage, right? But what it tells to me then, I'd be expecting to see various other fulfillment costs further down the P&L. Their churn is very optimistic, going from 31% a year, which is pretty good anyway, down to 9%. I mean, either they're expecting less competition, better product development in that time, where there's no accounting for in this doc. There's a little bit of tooling and CapEx down here. This is a thing that basically will drive this. So it's finding out what the relationship is between these two components here. And here, right, this is an interesting one. Classic mistake. So gross margin, I don't think that looks right. Yeah, that's not right. Look, so it put in a 62%, but then as soon as I put in my own formula, it's 30%, and it scales up. So that's embarrassing. If I got sent this model, I would be thinking, right, where's the credibility gone as a result of this? What other numbers in here are wrong? And it basically means that the deal was stalled a lot before. And so I would have to spend a lot of time doing this, which I wouldn't be very keen on doing because I'm a very busy person. So I'm coming back to the sales and marketing point, right? In that you've got marketing being, 25% roughly? 28% of your revenue, and then at the end it's less than 4%. Oh. That to me seems mental, and I wouldn't believe it. And the diligence that I'd want is an understanding of where this has come from, because there's no improvement here, what the improvement so far in 2026 is going to be, and then basically what the pipeline is for 2027, given the nature of this business and what it seems to be in a tech business. There should be pipeline out over the next 6 months or so. And the other thing is working capital in this business. There doesn't seem to be any working capital calculations in here, which is a big problem because that's something that founders underestimate, is how much capital is tied into that accounts receivables, accounts payables, basically that churning machine consistently. And the other really critical thing, never, ever in a financial model show you having loads and loads of closing cash. This should be used somewhere within the business. Ultimately, if you're a business that has all this closing cash, that's a big problem. You should always be spending cash to be growing. The fact that they sit on basically £7 million by the end of this year, unless they're using this as a way to argue back on investors, they will look, we don't need your money, we can do it ourselves, we want you here to be faster. This is a big problem. So I think the key takeaway for you, the viewer, is that bad investors basically just do spreadsheet maths. They'll just look at this and interrogate the numbers for what they are and look at the formulas. But a good investor will basically ask how true do each of these line items have to be, how are they all interconnected, and then ask for due diligence questions around that. So for example, the marketing point that I brought up. And the goal with this isn't to be like a cynic, but it's effectively to turn possible oversights into diagnostic questions. And in this, we've probably been looking at this for about 5 minutes and look at all the things that we've seen. So this is how investors look at things and this is how they think about it. And you can imagine if this company has come to me and they say they want 2 million for 10% of the business, valuing it at 20 million pre-money, you can see why I'd be pretty keen straight away after seeing a document like this to pull it down. But the most critical point is I can fix a broken model with a smart and honest team. What I can't do is fix a perfect model with a team that doesn't actually understand it. And if there are indications in the model that the founders don't understand their business, that's when you just walk away and you will put that down to the team just not being good enough to be the custodians of your capital. I've seen that recently. I was looking at an engineering business. I can't say too much because they're quite well known. They had a financial model that was just pants. And there were loads of massive mistakes. And the irony was that the founder showed me this and he was really proud. He's like, yeah, I built this myself. And I said to him, I can see. He's like, what do you mean? And I said, well, I can see that somebody with any kind of sense of finance hasn't built this. And if they had, that would be a huge problem. Because what he'd done is that he had basically, if we change this to like that business, he basically assumed that he was selling like odd numbers of these units that he was selling. So basically something like this, you see here, these numbers are rounded up, right? But if I actually change the number here, you'll see that first year is a round number, but then this year it's half a number. And I have never seen half of, like, you've never sold half of a laptop. You never sold half of an iPhone. But the problem was that he was getting half of the cash from it. So let's say that up here he had his sale price of £1 million. He was projecting cash through like this. When actually, this number's completely wrong. There's 50 grand's worth of cash there that's a phantom cash amount. And I just told him that he really needs to get somebody on board to protect him from making these really simple fuck-ups. And he didn't like that. So I'd done my job. Okay, so this is a cap table that Claude has generated for a company called Northwind Systems Limited. So this is their fully diluted cap table prepared for Series A. Illustrative. Okay, right, let's look at this. So Daniel Mercer, Dan is the CEO. He has 38% of the business. He hasn't invested in anything. He's just been given that. So then the CTO owns 22% of the business. Right, that is going to get a little red flag from me. And then this bloke, James Holloway, it doesn't say who he is. Oh, here we go. James Holloway, founding stage contributor, shares issued to a corporation, no vesting schedule attached. Right. Nuclear level sirens a la Nagasaki and Hiroshima going off right now. That is a big problem. And he invested £1,000 as well. Wow, what a good deal. So I wonder what these guys are going for valuation wise. Now, then Seed Line Ventures, 750 grand. Okay, they've got a seed pref. And then other angels, 165, and then the EMI options pool. Right. So the key things here, there's dead equity on this cap table. You've got James Holloway, who owns 12.5% of the business for basically £1,000. So this seems to me like nobody's getting that deal unless there's some kind of relationship. So I want to work out what the context is here, obviously. But then I also want to see here, no vesting schedule attached, right? That is a big, big, big no-no. Okay, he needs a vesting schedule like everyone else if he's going to be involved in this business. Or at least if I'm going to invest in this business. Now, this is a controllable issue, but it therefore becomes a closing condition. So he needs to either be bought out, he needs to be refinanced, revested. There has to be some kind of cleanup here. Otherwise, nobody else is investing in it because this is way too big of a number, 12.5%, for somebody to put in £1,000 and has no ongoing work, especially in the context where the CTO is on 22%. And what investors should be, yeah, there we go. So here you're thinking CTO is taking massive pressure, massive risk. This person, Priya, could probably go get a job at Meta or whatever, get well paid. And you wonder that when the rubber hits the road, so to speak, is Priya going to be happy enough with 22%, particularly if part of that vests over time? So the seed pref here is an issue because these guys carry a 1x pref. So what that means is if this business sold for 10 million, these guys, you would think if they didn't have the pref, they would get 13% of that, which is 135 grand. Sorry, 1.35 million. Cool, right? Now, it depends if they have participatory vesting or participatory pref. But effectively what that means is this number here has been calculated by the 13.5% that they own with the 10 million that the business is sold for. Now, in scenario 2, so I'm jumping all over the place. In scenario 2 here, if these people sold, but they sold for 1.5 million, well, then we have a big problem because Seedline Ventures put in 750 grand. So what that means is 750 grand goes straight to them. And then the rest of the cap table, they then get this on top. And the rest of the cap table is basically pushed out. So that's a huge, huge red flag. It puts a lot of pressure on the downside scenario. And the final thing here is the option pool is too thin. 6.5% is way too thin. And does it say anything here? Yeah, here we go. EMI option pool established at incorporation, 410,000 options dated. Right. So actually, there's only 240 of that left, which is basically a third of this. So basically, 2 and a bit % is unallocated, and that's nowhere near enough for somebody to hire a senior team. So this would mean that we would want this option pool to be refreshed. All of this existing lot will get diluted, and then we would come in. And I mentioned it. Yeah, the founder split is pretty pants. So that was about 10 minutes worth of footage where I showed what it would be like for an analyst or an investor or a manager like me to go through and read DD documents and try and understand the business. You get an insight into the type of questions that I ask and how I'm framing the logical sequence, because that's all investing is. It's thinking with imperfect information. And I'll leave you with this. If you had perfect information, i.e. you knew everything that was ever going to happen, would you ever make a bad investment? Of course not. It's my job as the investor to get as close as I can to that point of predictive success. For you as a founder, make that job easy for the investor, and it will bring you closer to the point of getting what you want from them. If you like this video, subscribe to the channel, like it, send it to all your founder friends, because I'm sure they'll find it useful and interesting. There's going to be more content like this coming out. And yeah, we'll be in touch.